Hi, John from Clinicom Systems here. Welcome to our accounting primer for managers. We're hoping in the next 30 minutes or so we can give you enough understanding of accounting to feel comfortable as a manager dealing with an accounting system. As you can see, this primer is divided into 4 segments. The first segment is on accounts. An accounting system is organized by accounts, and we want you to know how those accounts themselves are organized. The second segment is how a core accounting system works. How are those accounts managed? The third system is an overview of the various parts that make up an accounting system and how they all interact. And finally, the fourth part will be a wrap-up, covering some miscellaneous items not covered in the first 3 and some concluding items. So, let's begin with accounts. An accounting system uses accounts to track financial activity of an organization. And this isn't any different than what you're probably used to in your normal everyday life. You probably have a checking account, maybe savings accounts. Most of us are familiar with expense accounts, so we may not have one ourselves. And a corporate accounting system or a government accounting system is organized the same way, has the same types of accounts: checking accounts, savings accounts, and expense accounts. In an accounting system, accounts are grouped into 4 classes, and we're going to consider these 4 taken 2 at a time. You'll find out that accounts in a business accounting system are basically the same thing as you would consider them in your personal lives. For example, the first 2 classes are assets and liabilities. You have assets in your personal life, and they're very similar to those in a business. You might have a checking account, or you might own a building. Now, similarly, an organization, a business, or a government office may have inventory also. Again, these are assets in the normal sense of the word, and they're assets in the sense of accounting also. And it's similarly for the second class of accounts, liabilities. Most of us may have an automobile loan. We may owe taxes. These are liabilities, and they're liabilities in a business. So you'll find an accounting system has accounts and assets and accounts and liability. Now, what's interesting about these 2 classes, these 2 sets of accounts are generally used to show the net worth of an organization. Very simply put, if you take an organization's assets value and reduce from that it's the value of its liabilities, you have its net worth. And that's the way a business works. So we're going to demonstrate that by starting our own business. We're going to call it the Widget Company. So the first day when we open a business, we go to the bank and we borrow $10,000 to start the business. In our accounting system, this would result in 2 entries against accounts. The first one is an asset account. We'd put the $10,000 into a checking account, and in our accounting system that would be listed as an asset. But in doing so, we've incurred now a $10,000 loan liability, so we would create a liability account called loans and enter $10,000 on it. Now, what's the net worth of our new company? Well, it's assets minus liabilities, or $10,000 minus $10,000. So our assets, or our net worth of our company, is 0. Now, interestingly, in a business, that is one of the 2 financial statements, the 2 most common financial statements you'll encounter. And this one is the balance sheet. A balance sheet shows the net worth of an organization by comparing the asset to the liabilities. As you see here, our Widget Company balance sheet totals all the assets. In this case, we only have one, our checking account of $10,000, so our total assets is $10,000. And then it totals our liabilities, our loan in this case also $10,000, yielding a total liabilities of $10,000. And as a result, the net worth of our new company is 0. So what's the goal? Looking at this, you can probably guess what the goal of a company is, and that's to increase our assets and reduce our liabilities, yielding then some net worth to our company. But we want to warn you, if you're in a startup business or you're thinking of starting up a business, they can have a negative net worth until they get up and running. Now, what affects the asset accounts and liabilities, they're heavily influenced or impacted by the other two classes of accounts. And these are the revenue and expense accounts. And these accounts, like assets and liabilities, mean exactly what you probably think they mean. Revenue accounts keep track of money coming into your organization. Expense accounts generally track money leaving your organization or your spending. And if you look at pictures, they're things we'd be familiar with. Revenue, for most companies, comes from sales. Now, interestingly, you notice I list tax as a revenue. That's not for most companies. In most companies, taxes would be on the expense side. But if you're a government office, a municipality, your source of revenue is taxes. So taxes can be a revenue, at least for the government. And sales is typically for a company, and there can be other ones. You might have interest on a savings or checking account would be a revenue or a government grant. And then expenses, the fourth class of accounts, is also what you would think of in your personal life. If you pay rent, that would be expense. You have utilities, electric, water, those are expenses. You have insurance costs, those are expenses. So again, revenue expense accounts, just like assets and liabilities, are just what you would think they would be in your normal life. So we're going back to our Widget Company again to demonstrate these two accounts. So our day 2, we go out and we rent an office space, and we have to put down the first month $500. So in an accounting system, there would be 2 entries for this, just as there was with the loan. You can see the first entry is we lose $500 from our checking account that we set up in our last entry. But we also record an expense of $500. So as it points out at the bottom of the screen here, when you lower your checking account, if you think back to your balance sheet, which is your assets minus your liabilities, this would be a case where our net worth would go negative. But that is typical in a business. Don't despair, because as you'll see in a minute, the opposite also happens, and that is day 3. Day 3 of our Widget Company, we sold our first widget. So we'll see the reverse happening. We had a sale, and we sold it for $1,000. So now we increased our checking account by $1,000, and we did it recording an entry against a sales account, which is part of the revenue group of account numbers, for also $1,000. We see the effect of revenue accounts is the opposite of what the effect that expenses had. It increases our cash and improves our balance sheet. So things are looking up in our new company. And that is the goal of management of an accounting system. As you might think, it's so important that the second most common financial statement you see is called an income statement, and it compares those two items. Here you see it for our Widget Company. We under revenue, we list all of our revenue accounts, which we had 1, and it recorded $1,000 sales, so our total revenue was $1,000. But on the opposite side, under expenses, we did have an entry against the rent as an expense, and that was $500. So comparing revenue expenses, which is what an income statement does, shows a net income of $500. So easy to remember, net income is the revenue total less the expenses total. And you recall back to the balance sheet was the other two accounts, the asset total less the liability total. Those are the two financial statements that you should find in every organization. They're the most common, and they all work exactly the same way. Some of them are very elaborate. There is no limit to how many asset accounts, liability accounts, revenue accounts, and expense accounts you can have, but they'll all be organized as you see here. And that list of accounts is called the chart of accounts, and they're always in this order they should be. Assets followed by liabilities, followed by revenue, followed by expenses. So to recap what we covered, that wasn't so bad, was it? 4 classes of accounts. Assets and liabilities, which are shown on the balance sheet, revenue, and expenses, which are shown on the income statement. So that's it to knowing how accounts work. The layout of accounts in every accounting system should look like this. They simply will change in the number of accounts in each of these categories and the names they assigned each of those accounts, but this is how it would work. So that was the first segment. Hopefully not too bad. What we're going to discuss next is how does an accounting system track that activity. We showed 3 different times we made entries into the accounts here. Well, how does that happen in an accounting system? That's our next part. So if you want to take a break, then we will come back and pick up with part 2.